think that when the 2-year was at 0% for 15 years, people got a feel for what my answer is going to be. The 2-year is not going to stay at 4.96.
Right.
And let's say you buy it and then in 2 years it's still at 4.96. It won't be, and it isn't growing. That's the issue with dividend growth, is the growth.
Okay.
Not only do you get something that is consistently going to be at the level at which you enter, it's going to grow year over year. With fixed income,
hopefully, right? I mean, there have been companies like BP or Disney that have cut dividends.
It would be very, very important for a dividend growth manager to not allow dividend cuts to happen. So in 25 years, we've never had one, and I intend to go the rest of my career without one. But there are certainly companies that cut dividends, and we really don't recommend people
You don't get blindsided by something like BP? I mean,
yeah,
who saw that coming?
BP gave plenty of forecasts that what was happening. You had both President Obama and the former candidate John McCain recommending the same thing, that they ring-fenced $20 billion of liability damage around it. There was no way they were going to do that and keep the dividend. So it gave people months of time to sell before the dividend was cut.
And that's why I need someone like him, because I didn't know.
I didn't know that.
A career maker for me was Citigroup in 2007. They came out and announced that they were continuing to pay the dividend. And at that point, it was up to about 7% yield. The stock was down. And then they borrowed $11 billion from the Kuwaitis and Saudi Arabian Sovereign Wealth Fund. And I said, I don't think people taking advance on their credit card to pay a dividend counts. It has to come from free cash flow. They have to have lower leverage. You have to have a good balance sheet. You have to have a business model that leads to sustainable free cash flow. That's why we have to be actively managing.
So how many names are in your portfolio?
Right now, 33 names.
33.
We've never had more than 35 in my whole career.
And again, you're focusing exclusively on dividend growth, right?
Yes.
And how do you define, what's a good policy if I'm a CFO to plan my dividends? Is it a percentage of earnings? Is it a percentage of free cash flow? How is it?
Yeah, it's interesting. Dividend payout ratios refer to a percentage of earnings that are paid out, but we like to look at the free cash flow and what percentage of that's being paid out. And I think most CFOs in America are used to annualizing a dividend, even if earnings or free cash flow may be somewhat lumpy throughout the year. I think it's a much better way to do it and affect their growth one time a year, as opposed to kind of going up and down. We have, I think, 3 companies in the portfolio, and it's Blackstone, Apollo, and Blue Owl. They're asset managers that get carry, and carry is intrinsically lumpy, so they tend to pay it a little lumpier. But most just pay it in a systematic quarterly way.
So the ETF is TBG, the Bahnsen Group, pretty easy to remember. And so I click TBG Equity DES into the Bloomberg, and then I can click the Holdings tab, and I see Simon Properties as your top holding. Now, Paul and I don't know exactly what's in Simon Properties' portfolio, but Paul and I talk about commercial real estate with angst and fear every day.
Well, you're making a really bullish argument, by the way, for a contrarian investor, which is to say a good investor. But let me explain what's going on with Simon Property. It's 272 of the best malls in America. They have given the keys back for 4 of them. They were non-recourse. So they lost a little bit of equity, and the lenders had to go fight. Okay. Right now, they have the highest occupancy in the history of Simon Property, at the highest per foot in the history of Simon Property, 96.9%. They've taken positions in some of the retailers that have failed. There are going to be more that fail. Now they've learned to monetize that. They took JCPenney for $500,000 a box. It was trading at $20 million a box. They're selling some to Amazon. They're reconverting some into condos and mixed use. It's this massive collection of real estate that can be repurposed, monetized into something more valuable. While they do that, we get an over 7% yield, entirely covered by net operating income, and the leverage is at about 47%. It was 65% before the financial crisis.
All right, number 2 is Verizon. That makes total sense to me, obviously, as a dividend play. Number 3, International Business Machine, Big Blue.
One of the great names people could buy, and this is an idea of a model we like a lot. You have old businesses that don't grow a lot, paying you a ton of free cash flow, with new businesses that are sort of not priced in, that represent a free call option. Will they become a real leader in artificial intelligence? I don't know. I think they will, but I do know this: it's not priced in the stock at all. The stock is entirely priced off a multiple of its book value of a kind of more old, stodgier business businesses, but they have basically turned most of the business into software and consulting recurring revenue. So we love IBM. You get 5% dividend yield. The Red Hat acquisition was expensive, but they're monetizing it. So IBM's a great dividend grower for years to come.
All right, I'm heading down to Duke University this afternoon, and I may or may not bump into Tim Cook, CEO of Apple. If I were to get you two guys in a room talking dividends, what would you tell him?
Well, I would not tell him anything that others much smarter and more prestigious than me have not also told him, and they have failed, and so I'm sure I would fail. But what Apple's doing is shameful. And the inability to monetize that level of enterprise value, I think, is unacceptable. They will not do something with that $200 billion as profitable as returning it to shareholders. They bought Dr. Dre's headphone company for $3 billion. It wasn't worth $900 million soaking wet. But who cares? It's
Right.
Apple. They make it in 5 minutes. My point is, in aggregate, you can set money on fire when you don't have an adequate shareholder return policy. They are a victim of their own success. This cannot be said as a criticism. They generate too much free cash flow to reinvest all of it. It has to be returned to shareholders. There ought to be a very large, juicy dividend coming back to shareholders. Now, here's the thing. They're going to do it. Steve Jobs wouldn't do it. Tim Cook did end up doing a small one.
Yep.
They grew so much, the yield is now 0.5 percentage
Right.
point. I don't know if it's in a year or 10 years, but every one of these arrogant, cool tech companies finds out that at some point you have a higher return on equity returning this to shareholders. So all of the companies from the 90s that didn't do it, Cisco, Microsoft, Qualcomm, they all became great dividend growers later. Apple will as well. They're just not there yet.